In July of last year, BitMine Immersion Technologies closed at $135 a share, and Tom Lee was on every financial network in America explaining why this was the cleanest leveraged bet on Ethereum that retail and institutional capital had ever been offered. Today, that same stock trades at $21.88, an 83.8% collapse from the closing peak, and an 86.4% wipeout from its 52-week intraday high of $161. The company sits on 5,078,000 ETH, more than 4.21% of the entire circulating supply, and the mark-to-market damage on that stack since the August peak is approximately $13.3 billion in vaporized paper value. Other ETH Treasury vehicles have already started capitulating. The order books are thinner than they have been in years, and there is an $874 million cluster of leveraged long liquidations sitting just below the current price. Today, we reveal why the entire crypto treasury company model only works in one direction, why BitMine is the largest domino still standing, and the specific signals every ETH holder needs to be watching over the next 60 days. My name is Louis, and you're watching The Coin Bureau. Now, to understand how the most aggressive Ethereum treasury company on the market ended up trading at a discount to the very assets it was supposed to leverage, you have to go back to the summer of 2025. BitMine had IPO'd on June 5th at a closing price of $7.75, and within 30 days, it had run to $135, an 18-fold move on the back of a single thesis. The pitch from Tom Lee was a near-perfect rhyme of the MicroStrategy playbook that Michael Saylor had written to a 50-fold return on Bitcoin. Issue equity at premium valuations, deploy the proceeds into ETH on the corporate balance sheet, watch the asset appreciate, watch the stock amplify the move, and repeat. The reality is that this strategy did exactly what it was designed to do on the way up. By late August, ETH had ripped to a 52-week high of $4,953. The BitMine stack was worth approximately $25.16 billion at the peak, and the company was being treated by the market as the definitive ETH proxy. Furthermore, this was not a fringe trade. 463 institutional holders were on the register by the end of Q4 2025, controlling 148.4 million shares. Put simply, when the market believed in the cycle, the treasury model was the cleanest way to express that belief. And this brings us to the mechanics of why those same exact dynamics turn into a meat grinder when the cycle reverses. You see, a treasury company stock in a bull market trades at a premium to its net asset value, because investors are willing to pay extra for the implied promise of more accretive ETH purchases at higher prices. That premium is the engine that allows the company to issue fresh equity at $135, buy ETH with the proceeds, and grow ETH per share even as the share count expands. When ETH starts rolling over, however, that assumption inverts in three discrete stages. First, the premium to NAV compresses because the market stops believing future issuances will be accretive. Second, the premium flips into a discount because investors begin pricing in the structural fragility of a leveraged single asset balance sheet. Third, the discount widens until the company can no longer raise capital on terms that don't destroy existing shareholders. BitMine is currently in stage 3. The company's ETH stack at today's price of $2,334 is worth approximately $11.86 billion. The market cap is $9.95 billion. That is a 16.1% discount to the underlying assets. And for context, Strategy, the company that wrote the original playbook, is still trading at a 9.8% premium to its Bitcoin holdings. The reality is that the market is now telling you, in plain English, that it values BitMine at less than the sum of its parts. And BitMine is not alone in this. SharpLink Gaming, ticker SBET, transitioned into an ETH treasury vehicle in mid-2025 and rocketed to $124 a share. It now trades at $7.29, a 94.1% drawdown. Bit Digital is down 65.5%. BTCS is down 74.5%. And the entire category has been put through what amounts to a real-time stress test of the model. Now, the speed of this unwind makes traditional financial media essentially useless for tracking it in real time. This is exactly why we built the Coin Bureau Telegram channel, where we post breaking analysis on Treasury company filings, on-chain wallet movements, and ETH order book stress the moment the data hits. It is completely free to join, and the link is in the description down below. Or you could scan the QR code currently displayed on your screen. And given how fast this specific situation is moving, it is genuinely worth having on your phone. Now, you might assume that the ETH Treasury company unwind is a contained equity story that has no real bearing on the spot price of Ethereum itself. However, that assumption ignores what actually happens when the largest holder of a volatile asset is structurally pressured to become a seller. And the historical precedent for this is not abstract. The 2022 collapse of Three Arrows Capital and Celsius started with the same architecture. 3AC was managing roughly $10 billion at its peak, ran approximately 20 times leverage across Luna, ETH, and STETH, and faced creditor claims totaling between 3.3 and 3.5 billion when it eventually went insolvent. Celsius held approximately 25 billion in customer assets at its autumn 2021 high and filed Chapter 11 with a $1.2 billion balance sheet shortfall in July of 2022. Between those two failures, ETH dropped from approximately $3,000 in early May to roughly $880 by mid-June, a 71% decline in 45 days. The wrapper today is different. We're talking about public companies with equity holders and debt covenants rather than hedge funds with redemption requests. The mechanics of the unwind, however, are structurally identical. Concentrated exposure, leveraged balance sheets, mark-to-market losses that become real selling pressure, and an order book that has not yet priced in the supply about to hit it. And the order book matters here because the numbers are sobering. ETH 24-hour spot volume currently sits between 2.9 and 6.3 billion across major venues. A 10% liquidation of BitMine's position would be roughly 508,000 ETH, worth approximately $1.19 billion. That single event would represent between 20 and 41% of an entire day's global volume. Furthermore, 83% of the BitMine stack, or 4.194 million ETH, is currently staked, which means any forced exit has to route through a validator queue that has historically taken up to 9 days to clear. Put simply, the market would know the selling would be coming well before the ETH would even arrive on exchanges. And here is where the second order effects compound the problem. CoinGlass data from the first of this month shows approximately $874 million in leveraged long liquidations clustered just below $2,206. ETH currently sits at $2,334. If a forced sale pushes spot prices through that level, you trigger an additional wave of automated liquidations that have nothing to do with BitMine and everything to do with the structural fragility of derivatives markets, where open interest sits between $25.4 and $34.1 billion. And this brings us to the structural reality that nobody on the long side wants to confront. The crypto treasury company trade was the cleanest bull market story of the last cycle, and now it has the potential to be the cleanest bear market unwind. This is not a story about Tom Lee being wrong. It is a story about a structural design flaw that lives inside every public market vehicle built around holding a single volatile asset on a leveraged balance sheet. The same mechanism that drove the stock from $7.75 to $135 in under a month is the same mechanism currently driving the unwind. Leverage amplifies returns in both directions, and the cycle changed while the trade did not. The honest read is that the fundamentals of Ethereum are not what is at stake here. What is at stake are the mechanics of one large holder whose decisions are no longer fully their own. They are increasingly governed by capital structure, by shareholder pressure, and by the cold mathematics of a balance sheet that is now measurably underwater on a mark-to-market basis. So here is the practical framework for tracking whether BitMine becomes the next domino, broken into categories that historical precedent says actually matter. In the regulatory column, watch for 8K filings disclosing covenant discussions, debt restructuring conversations, or going concern language from the auditors. In the executive communications column, watch for any shift in Tom Lee's public framing from accumulation language towards capital preservation language. The 3AC precedent showed that leadership going silent on social media was itself a leading indicator. In the capital structure column, watch for dilutive equity issuances at depressed prices, which signal that the company is prioritizing liquidity over per-share value. In the on-chain column, watch for large ETH transfers from known BitMine wallet clusters towards centralized exchange deposit addresses, and watch for sudden congestion in the validator exit queue. And in the market structure column, watch for the BMNR share price diverging sharply lower from ETH spot, because that divergence is the market pricing in a Treasury liquidation conversation before the company has confirmed one. Any single signal in isolation is noise. 2 of these signals together is the moment to take notice. 3 together is the historical pattern of a forced selling cycle already in motion. So here's the question this entire situation forces every ETH holder to confront in the next 60 days. Will BitMine hold the line, find a path to refinance, and prove that the Treasury company model can survive a deep drawdown without becoming a forced seller into the underlying asset it was built to accumulate? Or are we watching the slow motion opening of a 2022 style cascade where the largest concentrated holder of an asset eventually becomes the trigger for the next major leg lower? Please get highly opinionated in the comments below, because this is exactly the kind of situation where the structural argument matters as much as the price action. And if you want to understand exactly how the original MicroStrategy playbook actually survived its 2022 stress test, why Saylor's capital structure was uniquely designed to absorb a deep Bitcoin drawdown, and what the BMNR balance sheet is missing that the MSTR had, well, then you should definitely check out our full deep dive video on the strategy Treasury model right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.